Rick's question is that I'm sorry for joining late, not sure if it's already been covered. Is there a way to sell calls when the stock has declined below your original cost basis? Is there a way out or just waiting that can lose you time? I ask because selling above the cost basis may not give you sufficient premium, so trying to understand how can you manage this situation effectively versus just waiting. All right. Now, why am I using pure storage for Rick's example? Rick's example, we have a stock that's moved down in price. It was a covered call, went against us. Hey, maybe Rick just opened a covered call or a position, whether it was a covered call or just a stock a couple weeks ago. And with everything that's happened in the last 5 to 7 days, now he's well below the original cost basis. He's looking at an unrealized loss on the stock. Does it make sense to sell a call underneath the cost basis? Well, it does, in a sense, Rick, but it comes with a lot of warnings and with a lot of cautions. Cautionary tales, I should say. So just about earlier this month, middle of the month, right about on the 10th, this is why I rolled up to the 70 put, because the stock had moved up to 68. And, you know, I've been through some ups and downs, and it hit 70 before. We did some other income methods, had this decline, pulled back up to near 70, and then it's declined again. Now, what I'm seeing in this situation for me personally, based on some of the things that I like to look at, this position is still showing weakness. This security is still showing weakness. The MACD is still negative and moving down. It is not troughing. It is not bottoming. And although we bounced off the lower Bollinger Band, it still is looking like it's in a trend. I'm going to wait for something like a bottom here in this, and that would be telling me that the stock's getting ready to potentially move back up. All right. Cost basis of $68 on a stock trading roughly at 59. That's what we're going to use here. This is the MACD 1226 against the EMA 9 for the divergence line here, Rick. Okay, so that is looking at the 1226 MACD line. All right, so you just asked that to clarify, is that the 30 days? Yeah, it's the 1226 there. Okay, so Rick, let's clear this out. I got to clear the drawings out. And what is the risk with the stock trading at 58, 59? 60, 62, maybe 65 strike is not out of bounds, but that's still way below our cost basis of 68. Let's use 70. We'll just use 70 even for this example, Rick. All right, so let's go back to PowerOptions. And again, we're going to go to that custom spread tool to build this on the fly. We have PSTG, pure storage. And just keep the math simple. We've got 100 shares of stock that we bought at roughly about $70 per share. Okay, we know the stock, as we saw, is trading at about $58, $59. Now, let's take a look here. We don't have weeklies. We only have standard with this one. So that makes it a little bit easier, because then you have to debate also with the weekly, hey, is it worth it to even sell 1 week out in time? Should I be doing 2 weeks out in time? What about 3 weeks out in time? Yeah, we know we get the better annualized return selling month by month. But we also only have 3 strikes to work with here, the 60, 65, and the 70. And as Rick mentioned, there's nothing here at the 70. That's why I'm not selling a 70 call on my pure storage married put right now. It has the 70 put. I don't want to sell a call beneath it because it's well below my cost basis. But even as a stock, what are the risks here? The term that's talked about, Rick, the term that's used from the old days, from when I first started trading options and beyond, is locking yourself into a loss. So let's say the best premium here, I don't think PSTG is going to move. Yeah, we've got 26 days or so until that expiration, but I think a good premium of 160 or so is going to help alleviate some of this, because, you know, I bought the stock at 70 and it's trading at 58. I'm down $12. So let me get $1.50, $1.60. And if I do that 10 or 11 times, 9 or 10 times, I'll pay for that 12% decline. Okay, but now what do we have a problem here with? Locking into a loss. I'm only 173 above the current stock price. If something happens next week with the Magnificent Seven, the stocks that are reporting the earnings next week in the Magnificent Seven, and they all just destroy the earnings and everyone becomes more buoyant, things like this in my portfolio, PSTG, MYT, Urban wouldn't have much of an effect, Urban Outfitters. But these are probably going to go back. Honestly, I've seen MMYT in 3 or 4 days go from $72 a share up to $83. I've seen Pure Storage do the same thing. We saw that chart just a moment ago, with just in a 3 or 4 day time frame moved up from 61 to 68. Okay, that's not that extreme, but that's a 7-point movement. In this case, oh, I'm sorry, that's the wrong one. In this case, I don't want that 7-point movement because that puts it up at 65. That's going to make me buy to close or try to roll this call and pay $6, $7 back when I only received $1.63 for it. Okay? So this is what people refer to when trading covered calls and doing this type of management about being locked into a loss. The stock suddenly rebounds after you're concerned about the decline and what happens. Now, if you doesn't make sense to roll it, the cost to roll it is too much. You can't roll it unless you go 4 or 5 months out in time or even 8 months out in time to roll for a credit, which probably wouldn't even happen. You're running the risk of getting assigned and being locked into that loss of 12.2%. All right, so I need more cushion, but what does more cushion mean? Gonna get less premium, Rick. So what about that September? Let's go further out. The September 65 is at 240. Oh, that's not bad. That's more than I was getting at the 60 for the August expiration, 16, 17, 18 days away, but still, potential loss of 3.8%. I at least gave myself some cushion, so if the stock starts to move up to 63 or 64, I can now look to roll it out further out in time. Okay, so does the 70 make sense? Well, 21 days away, what did we see? 15 cents? Okay, so we're not getting much for it. We're knocking down the cost basis a little bit. We could have a small profit of 0.3%, but is our expectation really that in 21 days it's going to be back above 70? Honestly, it could be. It's not a recommendation or suggestion, Rick. Honestly, this stock could be the way I've seen it perform in the past, with good news coming out and the rising tide lifts all boats. Their earnings, I don't think, are until another 25 to 30 days, if I'm not mistaken. Okay. How about, what do we have? We have a $12 decline. Does it make sense to go all the way out to March, maybe at the 60 or 65? Well, it's half, a little bit more, maybe closer to 2/3 of the loss. But now I'm sitting on a call for 238 days. We know the time decay is going to be extraordinarily slow this far out in time. That's just the nature of it. Would this get back me to a quote-unquote break-even, Rick, even if I waited the 238 days and the stock was back above 65? Yeah, 4.6%. Not a loss that we have right now in the stock, Rick, but 4.6% for 238 days out in time, plus however much longer you were in the position before this event. Okay? So, it comes with a risk selling calls below the cost basis, but you're right. In the sense that I can't go with a 70 call. Maybe I could go with a 70 call that's at my cost basis that's further out in time. Let's go to January. I'm going to get $1 or $2. Okay, $4 for that. That's not bad. But remember, I'm still down $12 on the position. So I've only collected 1/3 of it back, and I'm still 175 days out in time. I'm going to be waiting on this as it is to see any reasonable time decay to buy this back at a 70, 75, 80% profit of the 410 I collected. Just how the longer term options work. And of course, factoring in the at the money bell curve that we were just looking at, if the stock starts to move back up to 62, 63, 64, 65 in the next 30 to 40 days, this premium is going to swell. It's going to get closer to at the money, and you're going to see that. Okay? All right. Now, in the case of just owning stock, and this happens, another alternative is the stock repair tool. The stock repair tool will build a ratio, attempt to build a ratio call spread for you, buying one call at a lower strike and selling 2 calls at a higher strike to maybe get you back to break even faster. Now here, what did we do with this January 70 call that's at our cost basis? We lowered the break even down to 65.90. On those other 2, we saw we were locking into a loss. What was the break even there? There was no break even. We never got back to a profit. The best case scenario with the 60 call 1 month out was we would lose 12.2% instead of what we're losing right now. The best case scenario with the September 65 was that we would only lose, what was it, 8% if we got assigned, locked in that, or maybe it was 3%, I forget, but we would have that locked in loss. That is the best case scenario. There was no break even. Everything was a loss. So I'm going to go PSTG, and I'm going to go to stock repair. And in this case, my cost per share was 70 for 100 shares of PSTG. Now, we looked at the January option, the 70 strike. We didn't see any premiums that made up for directly the $12 unrealized loss that we have on the stock. Or a little bit less than that, $11.30 or whatever it is. However, we saw some ones where we could get back to a break even if we sold the call against the position. All right, so let's go ahead and submit that. I don't think we're going to see any. Okay, not too bad. We looked at the fail of just selling the calls for August and September where we would have that locked-in loss. We saw that using the January 65 and I believe the January 70, we could see a small profit on the position if the stock moved up to those strike prices, but that was, for 175 days at a time. And that break even we saw was 65.90, if I'm not mistaken, right? Yeah, 65.90. So with the repair, what we just see the potential here is we could enter a ratio call spread by buying 155 December strikes, selling 265s. Now we're only going to receive a small net credit of 50 cents. Well, my cost basis is 70. If I get a small net credit of 50 cents, doesn't that put my break even at 69.50? Why am I seeing a break even here at 62.25? And the reason why is because if the stock moves back up to 62.25, now this is at December expiration, Rick, when the stock repair works in this scenario. At 62.25, we have a loss on the stock of $7.75 because we paid $70 for it. Now, we collected 50 cents in premium for this adjustment. We're going to buy one December 55 call at $9.50. I'm going to sell two December 65 calls at $5. We're going to take $1,000 and pay $9.50 out. That's our 50-cent net credit. So at 62.25, I'd still be at almost a $7 loss. So my cost basis only dropped down to 69.50. I own one December 55 call that I was paid to own because I generated a credit of 50 cents. So now if the stock's at 62.25, my long call value, that 55 strike, is worth $7.25. The 265 calls expire worthless, so the $7.25 plus the 50-cent net credit gets me back to break even, much better than that January call at the 65 strike where we saw our break even only at 65.90. Okay, and then of course if the stock does move up, we have a potential to make a slightly higher profit on the trade if we get assigned on the 65 strikes. Now, that's the specifics of the repair details that you can see numerically. How does that work? But if we just go to Analyze Trade, that takes us to the profit and loss chart on the position. We have 100 shares of stock of PSTG at 70, currently trading at 58.27. We're going to buy one December 55 call. That's 147 days out in time. We're going to pay $9.50, so it's going to put our cost base up to $79.50, and we're going to sell 265 calls at $5 to take $10 back. So that's going to put our cost basis down to that $69.50. You're entering in a ratio call spread. You're selling 2 against 1. But none of these calls, this is not a naked position, Rick. The stock repair, of course, what we're doing is we have shares of stock. We're selling 1 call against those shares of stock to create a covered call. We're buying 1 call at a lower strike at 55 and selling a call at 65. So essentially what we just created is a covered call with a bull call debit spread. And the potential profit to get back to break even faster occurs because as the stock moves up, you see this heightened profit because as the stock moves up and goes above 65, we make the maximum on that covered call trade and we get assigned. And then the bull call debit spread, long 155 gives us the right to buy shares of stock at 55 and short 165. Everything is covered. 1 call is covered by the stock. 1 call is covered. 1 sold call, is covered by the long call we bought. We get the extra 10 points back. We essentially buy shares of stock at 55 to sell them at 65. We get the 10 points back in the position. And that's why the break even's at 62.25 because at that point, that long call would be worth that $7.25 plus the 50-cent net credit, and we're down $7.75 from our cost basis. That is the stock repair.